Hi, folks. Welcome back for another week of Making Sense of the Markets. This is Adam Taggart, co-founder of peakprosperity.com, and I'm back as usual with the lead partners from New Harbor Financial, the financial advisory firm endorsed by Peak Prosperity. We're also very fortunate to be joined this week by a special expert guest, Charles Hugh Smith, proprietor of of2minds.com and author of a huge number of books. Charles is a great and frequent contributor to peakprosperity.com. We're extremely lucky to get him this week, especially as he is joining us from the big island of Hawaii. Charles, thanks so much for taking a few minutes to join us this week.
My pleasure. Thank you, Adam.
All right. And the lead partners from New Harbor, John Loderer. Hi, John.
Hi, Adam, and hello, Charles.
Hey.
And Mike Preston. Good to see you, John. Mike.
Thank you. Nice to see you.
All right, so let's jump right in. I'm going to put a chart up here of the S&P. We've talked a lot over the past couple of months about the ferocious rally that the markets have seen since their March lows. I just want to point out that this rally is not just your average monster rally. It's actually the greatest 50-day rally in the history of the S&P. So we've been watching history going on here. As this chart shows, the first 50 days from the bottom were a gain of over 38% in just less than 2 months in the overall market. Just historically unprecedented, and really underscores what we've been waving our arms about, which is, hey, stocks were incredibly overpriced prior to the market break in February. Now they're pretty much back to where they are. Some indices like the NASDAQ actually hit some all-time highs in there. And of course, we know that earnings are cratering. So in terms of overvaluation, stocks are even more overvalued than they were before. And so the whole discussion that we've been having for the past several weeks has been how much longer can that continue, and what's going to continue to drive it. And certainly Fed liquidity has been a big part of the story. We'll get to more to that in just a moment in talking with Charles. What I want to point out here is bringing up this chart. We talked 2 weeks ago about the island reversal that we saw when the market had its 6% drop 2 weeks ago. And an island reversal, as we've talked about in the past year on the program, is a bearish technical analysis indicator that oftentimes presages a reversal in the markets. And what's notable about the current market action since that island reversal is that the markets have been unable to close the gap back up to where that reversal occurred. They've been struggling to try to close that gap. And that's a sign that the market is perhaps the rally is running out of steam here. We also have noted that there's now a second reversal, second island reversal. It's a one-day only reversal, but this happened 2 days ago, and you see that circled here on the chart as the second reversal. So now we have two bearish island reversal indicators in a market that's just sort of been chopping over the past couple of weeks. And what's interesting is, even today we had an update today, but the good news that was rolled out today, reaffirmation that another $1 trillion rescue stimulus package is on its way. And also the administration announced today that it's relaxing, or regulators announced today that they're relaxing the Volcker rule on the banks, which basically means that the banks have reduced stress test requirements going forward. These are things that normally really juice the market, and of course they did a bit today. But even despite today's update, it didn't even come close to gaining the ground that it lost yesterday. So these are all indicators for a market that all of a sudden is struggling to go higher. So with that background, Mike, why don't I just hand it to you? I know you guys are watching the markets even more closely than I. What is this action since the island reversal 2 weeks ago, where the market is kind of in this chop fest here? What is that signaling to you, if anything, at this point?
To us, Adam, the market looks tired. As you just mentioned, we've had two island reversals. These are bearish island reversals, meaning the islands are left above where the current price is. The market gaps up, and then it gaps down in the next period of time, leaving some trap buyers up in that island area. The market looks very tired. We just had the historic rally off the March 23rd low, as you said, 38% or so. That happened to actually work out to be 82% of the entire decline was recovered between the March 23rd low and the recent high a couple weeks ago. That's historically one of the largest retracements ever in what we would call a second wave counter trend bounce. You'd have to go back to 1937 to see something similar to that. Back then we had an 82% retracement, and then the market went down basically for 5 months straight. in a wave 3 move down. But looking at the big picture, if I look at the weekly chart, what this week has been so far has been an inside week, essentially meaning this week's high, this week's low was in the range, within the range of last week's range. And that just basically means the market is consolidating. It's building energy. What happens after a reversal, an inside week or an inside day or an inside month, generally is it's a market that's building energy, getting poised to move strongly in one direction or the other. Based on the fact that we think the market put a major top in, a very important top, especially when you look at the S&P on February 19th, and coupled with the fact that this second wave here has been filled with euphoria and low put call ratios and Robinhood traders and sports commentators bragging about their trading. This is pretty the bullish sentiment is what causes us major concern, and we think we're very, very late in this counter trend bounce, and it's probably time is probably getting short to reposition your portfolio if you haven't already. So, long story short, even though it doesn't feel like it, extreme danger right here. If we're right, the next wave down, being the third wave down, if we were to use Elliott wave terms, is the most dangerous and damaging of all. So we're watching it very closely, and we remain completely defensive at this time.
All right, John, I will come back to you in a moment, but I want to set things up here for Charles based upon what Mike said here. So lots of reasons to suspect and be suspicious of where market prices are right now. But there's a school of thought out there, and Mike, you referenced day traders. We ran that clip a few weeks back of Davey Day Trader, who basically said, look, with the Fed pumping all this liquidity in, stocks just go up, 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 and anybody that is conservative, is going to be on the losing side of the trade. So for those people who were talking about liquidity and that's all that matters, I'm putting up a chart here. This is a recent chart of all the activity by the Fed, both its Treasury purchases and its MBS purchases. And what this shows is what we talked about with Wolf Richter when we had him on the program a few weeks back, where yes, the Fed is still intervening into the markets and pushing liquidity into the system, but it really shot the majority of its ammunition, the vast majority of its ammunition, back in April. And if you look at the magnitude over the past 2 months to current, it's a tiny fraction of what it was back in April. It's really not that much liquidity. And so we talked about this a fair amount with Wolf when he was on the program. And what was really interesting is Wolf said that he watches this, these liquidity levels very closely. And with him, we talked about the dangers of shorting the market. And he had said, look, I don't short. Generally, as a principle, it's very, very rare that I go short. He wasn't short at the time we talked to him because of his skepticism of the Fed's liquidity being able to prop things up for a while longer. But we did ask him at the end of the program if he, was ever changing his mind, if he ever decided to go short, to let us know, because that would be an important indicator for us. Well, he reached out to me a couple of days ago and said, hey, Adam, believe it or not, I've now gone short. So Wolf Richter, the man who hates to short the market, has actually now gone short. And he's somebody who has been very, very closely following the liquidity side of the story. So to me, that is a really interesting indicator that says, okay, some of the people who were afraid to fight this market rally, in fact, who don't even like to go short, are now at the point where they're feeling compelled to at least put a few chips under that short side of the table. All right, so why this is important is because Charles has been writing some really interesting pieces, always writes great analysis, but he's been writing some really interesting pieces recently about factors that maybe most people might not be considering that could impact the markets. And Charles, one of the things I'd love to hear you talk about a little bit more is your recent writing about the deep state. Folks probably are aware of the deep state. It's something that's been in the headlines, ever since Trump started running for presidency, because he made part of his administration platform, I'm going to dismantle the deep state. I'm going to drain the swamp. And so it's very clear, to the extent that there is a deep state. And for those that don't know what that term means, it just means the institutions that tend to be very long-lived in government that outlast administrations. So this might be the military-industrial complex. It could be the Fed. It could be other organizations like that. To the extent one does exist, it has been knocking heads with President Trump over the past 4 years. And here we are at the end of Trump's last year, in his first year of office, running for re-election in November. And Charles, you've written some interesting pieces that said, hey, if you were part of the deep state and you didn't want this guy to get re-elected, you as being the deep state, probably one of the most effective ways you could thwart that second term would be to tank the markets in the run up to the November elections. So I'm going to hand it to you now to expound on that. But I thought that was a really interesting question to posit. And I know you've written a few pieces that, perhaps suggest that maybe we're beginning to see some indicators of that. But rather than put words in your mouth, why don't you tell us sort of, what you're seeing either through your crystal ball, or if this is a thought exercise, what are some of the key questions you think folks should be thinking of, when they think about black swans like this that could come out of nowhere?
Yeah, thank you, Adam. I'm going to just kind of pick up on Mike's comment about the bullish sentiment. In other words, we're really talking about psychology here, that, psychology drives markets and it drives politics, right? And so we're talking about potentially macro, large scale influences on the psychology of the populace that would play out in the economy and also in the markets, right? So it's interesting that we tend to think that these institutions like the Fed or the intelligence agencies or so on, that they're sort of abstractions, right? But in actual fact, they're filled with just people not that dissimilar from us, right? They have their job to do, they have an institutional agenda, and so on. So I think it's always an interesting thought experiment to put ourselves in their shoes. And so if you, the article that you referenced about the interplay of the deep state and the stock market and the potential effect on that on Trump's reelection campaign, is if I put myself in the shoes of somebody in the deep state, which has so obviously been attempting to derail Trump's presidency for 4 years, then you've sort of run out of arrows in your quiver here, except for the stock market, which Trump has consciously made a feather in his cap. In other words, he's often referred to the market as evidence of his successful handling of the economy and so on. So if you wanted to put a damper on his reelection campaign, you would seek out some way to crash the market, or at least cause it to decline as opposed to a euphoric advance. And so the best way to do so, if again, putting ourselves in the shoes of somebody in a deep state institution, would be to suggest to the Fed that they stop printing money that goes into the stock market. That it's fine if they want to create liquidity that goes into the real economy, which they appear to be trying to do. That's okay, but stop goosing the market. And another sort of similar thought process is, the Fed claims to be apolitical and above politics and all that, but of course they are also human and they read the papers, and so they are obviously under pressure, if you will, that they've been targeted as one of the key elements of rising wealth and income inequality, right? And they deny this, of course, but they deny a lot of things. We don't target the price of the stock market, et cetera, and it's all dismissed as garbage. So I think we could see why the Fed, even if we dismiss the deep state as an influence, we could see the Fed responding to these critiques of, you're the cause of rising inequality, which is now triggering social disorder. What are you guys going to do about it? Well, they could take the foot off the pedal of goosing the stocks and pursue only pumping money into the real economy. And there's certainly some evidence that that's maybe their policy going forward. So those are two sort of psychological or collective psychological issues, right? That the Fed would be responding to, not to market forces, but to political forces. And then my last point would be, let's consider what the impact will be psychologically if there is continued uncertainty about the virus. In other words, we had this euphoria, and my analogy is, when you get in an accident of some kind, your first, for me, I've fallen off ladders, I've fallen off roofs, that kind of stuff. Other people maybe had a car accident. And so, your first impulse is, oh gosh, how badly am I hurt, right? And so that's kind of what happened in the stock market crash too. Like, how badly are we hurt? And when you realize you survived and hey, the damage isn't so bad, then you have this euphoria, right? And then later on, you wake up the next day and you go, wow, I'm really kind of hurting here. Maybe I better go in and have an X-ray. And that's kind of what I foresee happening. And whether you want to call it wave 2 of the pandemic, or a lot of people are saying it, we didn't even get through wave 1, right? This is wave 1A. As the uncertainty piles up, that's going to affect the collective psychology, I think, and the euphoria is going to be very likely to reverse into, if not full-blown panic, then certainly a much more depressed, anxious mindset. So those 3 elements, I think, could really change the psychology of the markets going forward. So sorry that was so long-winded.
No, it was great. And I'm really glad you brought up the coronavirus part, because I meant to mention that earlier and didn't. But we've been seeing now a resurgence of cases nationally here in the US, right? Something like 20 plus states are now seeing daily increases. I think California just had its record day of infections ever. And so that's definitely got to be, increasingly weighing on market sentiment here, because I think so much of what the past 2 months have been is, hey, we've made it through this thing, to your point, that euphoria that kicks in when you realize you didn't die. But I think that to your point, if indeed the coronavirus continues to worsen such that we really haven't kicked this thing, that's something that could really impact sentiment. And in past weeks, the New Harbor guys and I have talked about that classic bubble sentiment curve, right? And right now we are in that return to normal phase, which if indeed what we've been seeing is a true bear market rally, and the rollover that Mike said might happen does indeed happen. Again, you and I talk a lot, Charles, about what drives markets. And at the end of the day, it really is sentiment. Right. It's once that marginal buyer has decided to flip from being a buyer to a seller, that's what turns markets. And so it'll be interesting to see if it's the coronavirus or if it's a rug pull by the Fed or whatnot. But the coronavirus one I think had been heavily discounted, and now it's sort of fighting its way back to the forefront of the game board here. So with that, Charles, we'll let you go because we know you're busy. But I do have one question for you about the Fed. Which is, I don't know if you have an answer to this, but they, I think we think that they've increasingly found themselves stuck in a corner of their own making, right? And they've gotten to the point where they can't raise interest rates without killing the markets, right? And the markets have become addicted to continued Fed stimulus. And so we kind of have this zombie economy and these Franken markets out there now. And I would have thought that the coronavirus would have given them a phenomenal, almost kind of get out of jail free card to be able to let the system to correct in a way where things would get a little bit more in balance with fundamentals and take some of the extreme excess out of the system and be able to blame it on the black swan of the coronavirus. But now that they've stepped in and helped kind of rescue the system and get things back up to where they were before, at least in terms of the markets, do you think they have the appetite to be able to now take some of the blame to let things correct in the way that you said that they might, because they're now getting those increasing criticisms of driving wealth inequality? I mean, if they didn't do it beforehand when they had the perfect opportunity, what are the odds that they'll do it now where they probably have to take a little bit more direct criticism as a result?
Good question. And I would say, they don't have a lot of wiggle room. And so I guess my context is the status quo, which includes the Fed and the rest of it, doesn't have a plan B. There is no visible plan B. So they just keep doing more of what created the problem and created the fragility that they're now dealing with. So that's where I think that they're backed into not just a corner, but to the edge of a cliff, is they don't seem to have a plan B. And so that's why they're sort of forced into this repeating the same kinds of policies, which just increase the fragility of the system. And I think that's what you guys have been talking about over the last couple of weeks is fundamentally the fragility of the stock market and the financial system, that it's the signaling device for. So,
yeah. All right. Well, last question for you, because I know that you are an expert in, or at least extremely knowledgeable in Japan. there are people who say, look, the Fed can continue to do this for the next, X years, decades, because look at Japan. They've been doing this for decades now, and they're still chugging along. U.S. has got a long stretch ahead of it. I think you share our issues and concerns about fragility, but in a nutshell, what may make it harder for the U.S. to succeed in trying to follow the path of Japan here?
Well, we should devote a whole topic, a whole session to that, because
sorry to make you summarize that in just a few seconds, but
yeah. Well, I think the key thing here that we can look at is the way that the stagnation in Japan's economy has not been fixed by the stock market recovering, right? The Japanese economy is extremely stagnant, and it's created a social decay, which those of us who follow Japan closely see, but a lot of other people don't see. And I'll explain that in very quickly. Is that you see, like, study after study coming out of Japan is finding that young people are not interested in marriage, not interested in having kids, not even interested in having sex, because they can't afford any of those things anymore. And that's the kind of social decay you get. You get a collapsing birth rate, you get a collapsing engagement in the social order. And I think we're starting to see those same trends in the US. So fixing the stock market doesn't fix your economy. And if you can't fix your economy, then your social order is going to decay. And that has long-term consequences, all of which are negative.
All right. Well, thanks so much. And we certainly are seeing decay both in our social order and our economy right now. So the stock market may just be the third shoe that needs to drop here at some point. Well, Charles, look, thank you so much. Really appreciate you joining us on such a busy week, answering some of these questions that are, like you said, probably each worth an hour exploration on, but doing a very good job of summarizing in just a few minutes. So thank you so much.
Yeah, and I'll listen to the program to hear you guys tear into my observations on sentiment. I'm happy to. I'll be looking forward to seeing what you guys have to add to that.
Great. Well,
Okay.
That's a great segue to you, John. So obviously, if you've got anything to build on what Charles said, please do. My general question for you is, should the markets drop from here, whether because it's a effort by the deep state to sabotage Trump's reelection, or for whatever reason, but let's say we have that kind of breakage in the markets. How would the New Harbor strategy, as it's currently deployed, fare in a situation like that?
Yeah, well, so we really don't care what a catalyst that comes around might be that causes what we really see to be an inevitable, sell-off in markets eventually. Could be sooner than later, but the valuations and extremities that we're seeing in all sorts of data, hard economic data, market valuation data, but also these psychological sentiment data, those all stack together to paint a very strong and robust picture that is in no small part validated by a historical precedent that we are destined to see significantly lower prices ahead. It's nothing in this life is certain, but there's certainly probabilities that can sway wildly one way or the other. We think the probabilities are wildly in favor of dramatic downturns in markets. And from that standpoint, we don't much care what the cause is. There's a saying that when you have a open gas canister by a crackling fire, any spark will do to ignite that canister. And that's pretty much how we feel. And it doesn't much matter to us what spark it is. It's just that we have a situation here that is ripe for explosion. And, coronavirus might have been the first ember that could continue to smolder and create a much more uncontainable fire. Could be, the deep state kind of behind the scenes kind of orchestration that certainly is plausible. I mean, maybe 10 years ago that might have appeared more conspiracy theory like, but I think most folks have seen in recent times how utterly non-transparent the elected leaders and institutions that are supposed to be looking after us, how utterly non-transparent they are, but also insulting in the way that, like, for example, the World Health Organization, pounding the table when we had a chance to contain this at a global level, that travel restrictions and trade didn't need to be curtailed. or earlier this, even our own policymakers here in the U.S., that masks weren't really useful or necessary. I mean, this just doesn't even pass the sniff test to basic reasonable people. So these, what might be considered conspiracy theories, there's a lot of good, understandable logic that when you understand the meta game that these policymakers are playing, absolutely, lies and mistruth are part of the casualty of policy, I suppose. But again, we don't really much care what the catalyst is, and what the way we're positioned right now, not because of a theory of a deep state or that we had inside knowledge about a global pandemic coming down. We are and have been very, very defensive, very conservative, just because the investment climate, the data we look at, justifies it, almost demands it. So we're very well prepared for any sort of decline right now, whether it be a small contained one or a big and swift one, and we will respond to that in a opportunistic way, and the degree of the response will be in no small part driven by how big the opportunity becomes. Quite simply, the bigger the sell-off, the more panic that sets in, and the euphoria gets priced out of the market, the more embracing we will be of it, because the risk will then be abated, and the likely returns from those levels will be much healthier and satisfactory.
All right, great answer. Mike, real quick, how are the conditions right now compared to the conditions in January and early February leading up to the market break? Are you seeing a number of similarities? Is it more extreme, less extreme? Like, what are you feeling right now when you compare the two?
On top of the technicals that we talked about, Adam, which are getting really tired. I mean, this is a market that's in a wave 2 counter trend bounce, and you're starting to see things like island reversals and stuff. So energy is getting thin. But interestingly, over the last 2 weeks, we've seen sentiment get euphoric again, really right off the charts. And there's been this wholesale capitulation, in talking to the people in the public, both clients and, other people that aren't clients, but maybe just inquiring or just want to talk with us. There's this wholesale buy-in about the Fed never letting markets go down again, ever. I mean, literally ever. And it's breathtaking, frankly, to see, particularly when we're so deep into this bounce. March 23rd, and here we are at June 25th. They're 3 months into this bounce, 82% retracement at the recent high. My grandfather and I were good friends. His name is Duffy. I still miss him. He was in World War II, and he had a saying. He had a lot of sayings, but he had a saying that keeps going through my mind: "Is later than you think." A little bit of a morbid thing you think about is later than you think, and I guess in life, but right now in the market is later than you think. We really think it's later than you think. With the euphoric sentiment, the huge retracement, the island reversals, we're going to just continue to be patient, step aside, and would not be surprised to see a move lower fairly soon.
Okay, and the reason why I asked that question is, I remember in my weekly discussions with you guys back in January and February, it was a tough time, right? Because the Fed had people's back then, right? It had been doing the overnight repo rescues, but then it had the not QE program that had started in late fall of 2019. So there was a strong sense back then that, hey, look, the Fed's got our backs here. And then all of a sudden, out of nowhere, right? The coronavirus came out of nowhere, but the markets then fell by over 30% in a very quick period of time, right? And just caught everybody who thought, when this rally gets long in the tooth, I'll kind of sashay over to the door and get out before the losses start, right? All those people were caught flat-footed, and there was real panic and despair. But past performance is no guarantee of future performance. But at that point in time, you guys had gotten similarly positioned to where you are these days, right? And I remember interviewing you and asking you directly, okay, the market's down. I think at that point it was down the S&P was down 33%. What's your portfolio done? And the New Harbor portfolio was up by 1%, which, we got an incredible amount of extremely grateful emails and comments from the people that we'd referred to you over the years, because in that type of environment, when people are taking those gut shots of huge losses, not losing money is just an unbelievably wonderful place to be in. So I'm mentioning this not so much to shine a bright light on New Harbor, though I'm happy to do that, but just to say, look, it's, from what I hear from you guys is, look, we've seen this movie before. In fact, we just saw it, a couple months back. We're seeing all the same warning signs, the same overextension, the same irrational euphoria, and I, it's recent enough for me to remember the despair we saw in the people who got caught by it and sort of played the game status quo wise and got surprised, versus the immense gratitude of those folks who moved to safety and security and moved to defense largely through your guys' guidance. So I want to underscore that because I know there's a lot of people right now trying to make sense of, boy, I hear everything Mike and John are saying. It makes sense to me, but gosh, I'm looking at, either my portfolio or my brother-in-law who's day trading now and just every day is telling me how much money he's made, right? That siren song of the market psychology that we've been talking about, it's really hard to resist. And of course, that's what a bear market rally is designed to do, is to suck in every possible bear and get them to capitulate before it rolls over. So anyways, just thought it was really important to emphasize that. All right, as we close here, John, I want to bring it back to you. I know before we started recording, you'd mentioned you were seeing some things in the market that may be worth noting here. I think you said something about high yield debt, but is there any other development in the market that you think is notable for today's viewers to be watching?
Yeah, just a couple of things. Obviously, we look at a pretty wide dashboard of data and indicators, and it's not, one data point in and of itself isn't a picture. We kind of liken it to a jigsaw puzzle, right? You have enough of pieces of a puzzle starting to fall into place that you can kind of see an emerging picture, right? Until you have enough pieces, that picture is just anybody's guess what the ultimate picture is going to look like. So yeah, but we look at a lot of different indicators, and just some that I can point to that, alongside this stock market euphoria, which has run into just a recent rough patch, of course, with yesterday's sell-off and today's, somewhat muted, response to what would otherwise be pretty earth-shaking, news about, relaxation of, bank stress test requirements. So Treasury bonds have been fairly strong in recent days. So yields on those have dropped, but the bond prices have gone up, and that's usually indicative of a flight to safety, a growing uneasiness about economic growth prospects. You name it, and all kinds of bonds really trade relative to Treasury bonds, and it's the spread on the yields of those bonds that speak to the relative comfort level of those assets relative to the gold standard. Maybe I shouldn't use the word gold standard, or the stability of Treasury bonds. And noticeably in recent days, the Treasury bonds have been strong, but high yield junk bonds, corporate bonds, have started to turn over. So there's been a departure of sorts. It's early, but it's a departure. And the result of that is the yields of those junk bonds have started to increase relative to Treasury yields. That is a sign of uneasiness about the credit markets, even though the Fed has been not only jawboning, talking about intervening in a big way. They have been in the junk bond market, and even yet we're starting to see this little bit of departure, which it's early on, but it's noticeable, and one of those maybe very important pieces of the puzzle. The other thing I'll point out is that we've been very long proponents of holding real assets like precious metals, both in maybe physical form, but also in investment vehicles. We like gold mining stocks as one area of the stock market that is tremendously undervalued still, and especially if we see higher gold prices ahead. Just notable that gold prices in particular have been at recent multi-year highs. We're seeing just in recent days levels we haven't seen since 2012. That's an important thing. I mean, gold is oftentimes a very underwatched but very important referendum on what's going on, not only policy-wise but also with stability and confidence in safety in the system. So there's just a couple of other things we're seeing.
All right, great point. I'm glad you mentioned gold and gold hitting an 8-year high earlier this week. That is a big development, and I think that we should maybe make next week's market update really pretty precious metals focused because there's a lot going on there, and we didn't really even get a chance to discuss it at all this week. So I'm really glad you highlighted that. All right, guys. So with that, we'll bring it to a close. I know you guys continue to be busy and want to make sure you get back to answering the phones and emails for clients. All right, folks. And don't forget, if you are new or repeat watcher here, you can at any point in time reach out to New Harbor, talk to John, Mike, the other folks in their team, and get a free consultation where they'll happily review your current financial situation, your goals, and give you their honest thoughts about what you should be considering doing in your portfolio. It's all for free, doesn't cost you anything, no strings attached. If you want to hear the details, when we end up here, just listen to the last minute of this video. We kind of go through the details and tell you how you can go request that free consultation. But with that, guys, looks like you got something to say, John?
So Mike made mention of his dear grandfather, Duffy. I could not pass up the opportunity to, maybe Mike will blush a little bit here, but Duffy, Mike shared a quote of Duffy's with me many times over the years, and it was simply, people have more fun than anybody. And it's a saying that I've come to really love, and especially in these times, let's remember, folks, to have some fun and be happy and smile. And even if we're, having to be distant from people we care about or socially, still plenty to smile about. And
thanks, John. You guys are familiar with the 8 forms of capital here that we talk about at Peak Prosperity. And while on these market videos, we really just focus on the financial capital form, we always like to remind people that each of those forms of capital is equally important. And so emotional capital, social capital, spending time with the people in your life. And one thing I like to always point out for folks is when you see centenarians, people that have made it to 100 years old, be interviewed about, what's important in life, it's always about relationships. It's never about things. It's really not even that much about accomplishments. It's all about the value of their relationships with the people in their lives they care about. So Very good on you to reaffirm that. And Mike, wish we all got a chance to know Duffy. I'm feeling left out here.
Me too. His birthday was June 19th, 1920. He would have turned 100 the other day.
Oh, he would have been a centenarian. All right. Well, here, as we part here, guys, I'll say thanks, and I'll raise my glass of sparkling water here to Duffy.
Paper cup. Cheers.
All right.
take care, guys. Bye, Adam.
See you all next week.
Bye, Adam. See you later.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.